Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. You're probably familiar with what a mutual fund is. To recap, it's basically just a big pot where investors pool money so that the pool can buy a diversified portfolio of securities. And each investor in the fund owns a prorated share of that pot. Mutual funds are a great way to easily and efficiently get yourself a lot of investment diversity. Well, there's another type of lesser known pool investment vehicle called an interval fund, and I'm about to explain what it is. If you like this video, please be sure to subscribe to this channel and click the little thumbs up icon below. Thank you. Before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. The best way to explain what an interval fund is to compare and contrast it to a mutual fund. Let's take a look. Like mutual funds, interval funds are overseen and regulated by the Securities and Exchange Commission, or SEC. And also like mutual funds, the price or valuation of an interval fund is determined on a daily basis when the fund calculates its net asset value, or NAV. NAV is simply just the sum of the value of every investment the fund holds minus any debts or expenses the fund has. Interval funds are also purchased like mutual funds. Neither fund type trades on an exchange like stocks do. Instead, when you buy a mutual fund or interval fund, you ultimately purchase your shares direct from the company that manages the fund. These purchases are also sometimes called subscriptions. Now here's where the differences between mutual funds and interval funds really begin. Recall that both mutual funds and interval funds are just big pooled pots of money. Investors contribute their money into the pot, and then the pot of money is used to buy a bunch of individual investments. In the case of mutual funds, the money is used to buy traditional liquid investments like stocks and bonds. In the financial world, the term liquid means how easy it is to sell something quickly and with minimal impact to its pricing. As an example, with the vast majority of stocks, you can sell the position in a matter of seconds. And the price at which you sell the stock usually won't be significantly different from where its quoted price is. In other words, there are a lot of buyers and sellers willing and able to transact in the shares such that there's a lot of supply and demand for the shares, which means there won't be large differences between the prices at which buyers are willing to buy and sellers are willing to sell. That's liquidity. Whereas mutual funds invest in liquid investments, interval funds typically do not. Instead of traditional stocks and bonds, interval funds generally invest in illiquid investments like physical real estate, private loans, reinsurance, and high-yield bonds. You can see how asset types like these are much less liquid than stocks. For example, many interval funds focus on real estate and will often own actual buildings in their portfolio. Now, buildings don't trade on an organized exchange like stocks do, and you can't quickly or easily sell a building. It can take months to sell real estate, whereas it only takes seconds to sell a stock. The next difference between mutual funds and interval funds is their fees. Most mutual funds have an all-in annual expense ratio well below 1%. Additionally, while increasingly less common, some mutual funds also have commissions or loads that are paid when you buy or sell the fund. Interval funds similarly have an all-in annual expense, and it's common for that expense to be between 2 to 3% each year. And interval funds may also have commissions or loads to buy or sell the fund. Furthermore, many interval funds will impose an early withdrawal penalty if you redeem any of your investment within the first year or so. These next 2 points are where interval funds really differ from mutual funds, and not in a good way, unfortunately. With a mutual fund, you're able to sell out of your position on any trading day. Again, because mutual funds aren't traded on an exchange like a stock, you don't sell it in the market. Instead, you redeem your holding direct from the fund management company. In most cases, you get your money back the next business day. Interval funds only allow you to redeem out of your position once every 3, 6, or 12 months. If it's in between the scheduled redemption dates and you want to sell out of your position, tough luck. You'll have to wait until the next redemption date to put in your request to get out. With mutual funds, there aren't limits on how much redemption you can request. If you want to get out of the entirety of your position, you can. But with interval funds, there are very strict limitations on how much you can actually redeem on each redemption date. The funds can limit redemptions to between 5 and 25% of aggregate shares outstanding. And if the total amount of redemption requests submitted exceed the limit, everyone will get their redemption request prorated and reduced. For example, at one extreme, assume every single person who owns a certain interval fund requests to redeem all of their shares on a given redemption date. In this case, the fund can cap the redemptions to potentially as low as 5%, which means everyone will get their redemptions prorated such that they all only get 5% of their shares redeemed, even though they requested redemptions on 100% of their shares. Do the math on this. Because redemptions are limited to only 1 to 4 times per year, and because redemptions can be capped at no more than 5% per redemption period, it can potentially take many years to completely get out of a position in an interval fund. Thankfully though, many interval funds do have a de minimis exemption to the redemption cap. As an example, if you own only a small portion of the fund, such as 100 shares or less, the fund may completely redeem you out before applying the 5 to 25% cap on everyone else's redemptions. Now, to be fair, there is a reason why interval funds have such prohibitive redemption rules compared to mutual funds. Because mutual funds only invest in liquid securities like stocks and bonds that can easily be sold within a day, mutual funds are able to offer virtually unlimited daily redemption abilities to their investors. With interval funds, due to the nature of them holding illiquid assets like physical buildings, they can't possibly sell everything in their portfolios quickly, which is why they need to put in place such punitive redemption limitations. And the nature of interval funds portfolios also explains why their fees are so much higher than those of mutual funds. Because it takes a lot more research and analysis and work to find and invest in things like buildings and private loans than it does to invest in relatively commoditized investments like stocks and bonds. So, that begs the question, if fees are substantially higher and redemption abilities are comically restricted, why would anyone ever invest in an interval fund? Well, what makes interval funds look so comparatively unappealing is also what gives them the ability to potentially provide some unique value. Because interval funds invest in illiquid assets held for the long term, they in theory have the ability to provide higher ongoing yields, aka interest or dividends, to investors. In other words, higher risk, higher potential return. As of the making of this video in early 2021, the typical annual dividend yield of a stock mutual fund, or the interest yield of most bond mutual funds, is maybe around 2% per year, give or take a little. But with an interval fund, it's not uncommon to have a yield of around 5% per year, maybe even more. Also, interval funds could potentially provide returns that are uncorrelated to those of traditional asset classes like stocks or bonds. Now that simply means that the return of interval funds may be independent of the returns of more traditional assets. So even if stocks go down, interval funds may not, and vice versa. Those are the potential benefits of interval funds, higher yields and returns that are not correlated to those of traditional asset classes. However, those benefits aren't guaranteed. Furthermore, you need to lock up your money for potentially many years in an interval fund. In other words, they are long-term investments, potentially very long-term investments. They're not like mutual funds where you can get out on any given day. To sum up, interval funds aren't inherently good or bad. They're like any other tool in the financial world. They have their place and can make sense when used properly in the right set of circumstances. But before buying an interval fund in an attempt to get yourself higher return than what you can get from most mutual funds, make sure you're fully aware of the fees and redemption restrictions on the fund. Don't invest in an interval fund unless you're willing and able to keep the money there for potentially many years. Well, that's it. I hope you found this video helpful. Please be sure to like this video and subscribe to this channel. And if you haven't already, subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.